Hello, and welcome to today's show. Today, we're going to be talking about behavioral finance. Financial decision-making is a complex process that involves both rational analysis and emotional responses. Behavioral finance is a field of study that explores how our biases and heuristics impact financial decision-making. Today, I'm going to be talking about some of the most common behavioral biases and heuristics and how they can impact our financial decisions. One of the most common biases is the overconfidence bias. This bias can lead us to believe that we have more control over our financial outcomes than we actually do. For example, we may believe that we have the skills to pick winning stocks or that we can time the market perfectly. However, research has shown that overconfidence can lead to poor investment decisions and lower returns. Another common bias is the confirmation bias. This bias can cause us to seek out information that confirms our existing beliefs and ignore information that contradicts them. For example, we may only read news articles that support our investment decisions and ignore articles that suggest we should change our approach. This bias can lead to a lack of diversity in our investment portfolio and increased risk. The availability heuristic is another common bias. This bias can cause us to make decisions based on the information that is most easily available to us. For example, we may invest in a company that we recently heard a lot about in the news, even if it doesn't have a strong track record. This bias can lead to poor investment decisions and a lack of diversification in our portfolio. The sunk cost fallacy is another bias that can impact our financial decision-making. This bias can lead us to hold onto an investment that has already lost value because we feel that we've already invested too much in it. This can cause us to miss out on better investment opportunities and can lead to further losses. It's important to be aware of these biases and heuristics and to work to overcome them. One way to do this is to seek out diverse perspectives and information when making financial decisions. Additionally, it's important to have a clear plan and strategy in place to help avoid emotional decision-making. In conclusion, understanding behavioral finance can help us make better financial decisions. By being aware of our biases and heuristics, we can work to overcome them and make more rational decisions. Thank you for tuning in today, and we'll see you next time.